So you're going to hear the term EBITDA a lot, especially if you're seeking financing or any kind of funding. So what is EBITDA? It's specifically earnings before interest, depreciation, taxes, and amortization. What does that mean, Mitch? Well, those are 4 expense line items, and here's why we don't care about them. That's why it's before. What before means is that we take your net income and we add back those expenses. We assume those expenses weren't incurred to get your EBITDA. So let's go through them. Interest. The reason we don't care about interest is because interest is typically generated by a business that has a loan. If I'm going to buy your business or invest in your business and I'm going to do it all with cash and pay off that loan and we're not going to have interest, I don't care what your interest expense is. So we back that out because that is an expense you incurred based on how you chose to finance your working capital, not a true business expense. The second one is depreciation. Well, depreciation is an accounting number. It's not a real cash expense. That's why we back it out. Even if you're doing your accounting on a cash basis, you're going to have depreciation because your accountant probably going to put some in there. What that is if you buy a large piece of equipment for a large sum of money, say $100,000, they're probably not going to put on your income statement that you spent the $100,000. They're going to spread that out over a number of years, and they're going to put in a portion of that, and that line item is called depreciation. The reason we don't care about that from a valuation perspective is because it's a non-cash expense. You spent $100,000 3 years ago. Just because you have $10,000 worth of depreciation this year, I'm not going to incur that same expense when I buy your business because I will have paid that asset off when I buy your company. The third one is taxes. So taxes, the reason we don't care about taxes is a structure issue. I may buy your company and do it as an LLC, and I don't care. We will not incur any taxes. The only reason you incurred taxes is because you chose to set it up as a C Corp or some kind of taxable corp entity, and I may choose to do it differently. And because of that, I'm going to back out taxes from your net income so that I get a fair view of what your true operating expenses are. The last one is amortization. That's a weird one. Amortization is exactly like depreciation, but it's usually not with a hard asset. So when you buy a business, for example, a lot of times you buy what's called goodwill. That's the value that the business has because it's an ongoing entity. Goodwill typically gets amortized over a number of years, and so again, it's a non-cash expense that the accountants decided to put on your income statement, and me as an investor or somebody looking to value your company, I don't care about it. So I'm going to back out interest, depreciation, taxes, and amortization, and that is the EBITDA, or adjusted net income, that I'm going to use in the valuation process in valuing your business.